Hello everybody, in Module 2, I discussed feedback effects. Module 2 has 6 lessons. Today we're focusing on Lesson 4, how feedback effects can generate manipulated short selling. Short selling is a controversial activity. It is usually a scapegoat during stock market crashes or crisis period. In those periods, many people would support banning short selling. There are always arguments in favor of or against banning short selling. The typical argument against banning short selling is that short sellers have negative information. Through short selling, they convey such negative information into the capital markets. So if you ban short selling, it suppresses negative information. It reduces price informativeness. So do not shoot the messenger. The argument in favor of short selling ban states that short sellers, they may not have information at all. They just spread rumor and convey false information into the market. By pushing down prices, they benefit at the expense of driving legit firms out of business. So banning short selling can remove the so-called manipulative short selling. The argument has two issues. First, how manipulative short selling can benefit short sellers. If everybody knows that short sellers are uninformed, why would the price decrease? The second issue is why this logic only applies to short selling. Why this logic does not apply to, for example, manipulative buying. Ghost and Gumbo, 2008 Review of Economic Studies paper, addressed both issues. Let's look at the big picture intuition. The speculator can be informed or uninformed. Only the speculator knows about this. The market, the manager does not. So the speculator can exploit this information advantage to generate profit from trading. However, without feedback effect, the uninformed speculator is not going to trade. That's because the uninformed speculator is uninformed. The uninformed speculator expects the firm value to be the ex-ante firm value. When the uninformed speculator buys, price is going to increase above the ex-ante firm value. When the uninformed speculator sells, price is going to move below the ex-ante firm value. So the price is always going to move against the uninformed speculator's trade. And the uninformed speculator is going to lose money. With feedback effect, however, the uninformed speculator can find short selling optimal. The reason is the manager does not know whether the speculator is informed or not. So when the probability that the speculator is informed is sufficiently high, the manager would believe that for negative or sufficiently low order flow, it likely conveys negative information. So the manager is going to cancel the project that ex-ante has positive NPV. So for the uninformed speculator, they're not going to lose money when the order flow is low, as in the case without feedback effect, because price is just going to be zero. The payoff is going to be zero because the project is going to be canceled. However, they could make money if there is sufficient noise buying, which pushes the order flow to be higher. And so the manager is going to set a higher price than the expected firm value. So in this case, manipulative short selling would be profitable for the uninformed speculator. Manipulative buying, however, would not be profitable because the manager is not going to change decision because the project is positive NPV. Therefore, when the uninformed speculator buys, the price is still going to move against uninformed speculator. The project being ex-ante negative NPV is not going to help manipulative buying either, because when the project ex-ante has negative NPV, the manager is not going to invest. However, if you have manipulative buying, the manager might be tricked into investing in those bad projects, which means the firm value is going to be even lower, making uninformed buying not profitable. Now let's illustrate the intuition using a simplified model. There are 3 dates, 0, 1, 2. At day 0, there is a risk-neutral speculator. The risk-neutral speculator may be informed with probability alpha. If the speculator is informed, the speculator learns about the underlying state of the world, omega either H or L. If the speculator is uninformed, the speculator observes nothing. At t equals 1, trade occurs in a discrete Kyle setting. At t equals 2, the manager makes investment decision based on whatever information is contained in the trading at date 1. The investment decision is either 0, which means no investing, or big K, which means invest. Firm value is a function of both the underlying states and manager's investment decision. When the manager chooses not to invest, firm value is normalized to 0. When the manager chooses to invest, and if the state is H, firm value is V plus, which is higher than the value of non-investing. When the manager chooses to invest and the state is L. Firm value is V minus, which is negative, which is smaller than the value when the firm is not investing. The prior probability of omega equals H is 1/2. And we assume exante the firm has positive NPV, which means 1/2 V plus V minus is bigger than 0. The trading occurs in a discrete Kyle type model. The speculator can either short sell one share, no trade, or buy one share. There are two noisy traders. Each noisy trader independently submit an order flow with equal probability. So they can equally short sell one share, not trade, or buy one share. That means the total noisy trader distribution can be either from -2 to 2 with the following probabilities. Why we need two noisy traders? To make the trade sufficiently noisy so that the uninformed speculator would find short selling optimal. The market maker again observes total order flow and prices the firm. Again, as in the feedback literature, when setting the price, the market maker is going to anticipate that the manager is going to learn from the price, take a real decision which affects the firm value, and in turn the price. We can show that the informed speculator will still trade consistent with their private information. They're going to buy one share when they observe H and sell one share when they observe L. The manipulative short selling is precisely defined in this setting as the uninformed speculator short selling. We can show that in a no feedback benchmark, which can be characterized by the manager always knows about omega. In this case, the manager is not going to learn from prices. So whenever the uninformed speculator is going to trade, price is going to move against the uninformed speculator. So uninformed speculator's trading is going to be unprofitable. With feedback, we can also show that it's never optimal for the uninformed speculator to buy. The reason we already talked about that. Buying is going to push up the price, moving the price against uninformed speculator's trade. Uninformed speculator is going to lose money. We can show that uninformed speculator short selling can be optimal when the probability of the informed speculator being present, or alpha, is sufficiently large. Given this strategy, the market maker is going to calculate the posterior distribution of omega using Bayes' rule, because omega is an exogenous variable. When X is +2 or +3, the order flow is fully revealing that speculator is positively informed. Because if the speculator is uninformed or negatively informed, they would place -1 order, and the total order flow cannot be +2 or +3. That means the posterior probability omega equals H is 1. So the price will equal to V plus, as the manager is going to invest. When X is -2 or -3, it is fully revealing that the speculator is either negatively informed or uninformed. If we assume that alpha is sufficiently large, then those order flows are sufficiently negative so that the manager is going to cancel the project. The price is going to be 0. When X equals 0, we can show that the order flow is completely uninformed because the project has positive NPV, the manager is going to invest. So P0 is just exante firm value from investing. When X equals 1, we can use Bayes' rule to figure out the posterior belief omega equals H is bigger than 1/2, which means that the project is even more positive NPV. So the manager is going to invest. And price, when order flow equals 1, would be the expected value of the investment project, conditional order flow equals 1. When X equals -1, the manager, the market is going to downgrade the posterior belief that omega equals H. It's going to be smaller than 1/2. If we assume that alpha is sufficiently large, which means that -1 order flow is sufficiently informative that bad news is being conveyed in the markets, then the manager is not going to invest. P-1 is going to be 0. This ensures P-2 and P-3 will be 0 as well, because they're even more negative order flows. So even more pessimistic belief about omega equals H. We can now calculate the uninformed speculator's payoff from short selling. When the uninformed speculator short sells, the total order flow could be all the way from -3 to 1. When the order flow is -3, -2, -1, the manager is going to cancel the project. So price equals 0, firm value equals 0. The short seller, the uninformed speculator, does not lose money, which is very different from the case when there is no feedback. When the order flow equals 0, price equals the exante firm value. the uninformed speculator does not lose money. The uninformed speculator is going to make money when the noise trading is sufficiently high, so the order flow becomes +1. In this case, the manager is more optimistic than the prior about the prospect of the project. So the manager is going to set P1 to be bigger than ex-ante firm value. And that's when uninformed speculator is going to make a profit. So we can show when alpha is sufficiently large, the prospect of the project when order flow equals -1 is sufficiently pessimistic, so the manager is not going to invest. And this would make the manipulative short selling optimal. Now, we show that manipulative short selling is optimal. Is the previous arguments that banning short selling a solution for removing manipulative short selling or increasing firm value? In this setting, while manipulative short selling can arise endogenously, banning manipulative short selling always hurts the firm. Because banning manipulative short selling also bans informed short selling. In this case, manipulative short selling is optimal because price is informative, and that's because the probability that the speculator is informed is sufficiently high. Recall that for manipulative short selling to be optimal, alpha has to be sufficiently high. When you ban short selling, you also ban informed short selling. And because informed short selling happens with sufficiently high probability, the loss from banning informed short selling dominates the benefit from banning manipulative short selling. So short selling makes the firm. Short selling ban makes the firm worse off. I have a paper published in 2025 in JET, which shows that in a bank run setting, banning manipulative short selling could be optimal, even when the probability that speculator is informed is low. The reason is that bank runs can be self-fulfilling. So for bank runs, you don't really require informed speculator because even without informed speculator, if you're concerned that others are going to run the bank, you're going to run the bank itself, even when the fundamental is solid. So in this case, manipulative short selling can be optimal, even when the probability of informed trading is sufficiently low. So in this case, banning all short selling could be beneficial because the probability of informed short selling is low. So the cost from banning informed short selling can be dominated by the benefit from banning uninformed short selling. To conclude, feedback effect can generate manipulative short selling. In this case, uninformed speculators, they can pretend they're informed and short sells. The manager is not able to tell whether the order comes from the uninformed speculators or the informed speculators. They will be tricked into taking a corrective action, in this case, canceling a project that is otherwise positive NPV. This reduces firm value, and this can make short selling profitable for uninformed speculator. In the next lesson, we're going to introduce disclosure into a feedback model. We're going to illustrate how the presence of feedback effect may discourage firms from disclosing certain information. If you want to test your understanding of this lesson, again, check the link provided in the slides for a review quiz. Thank you very much.